Okay, good morning, everyone. So in this video lecture, we will be discussing the introductory lectures on financial management. Basically, in this session, what we'll do is we will be discussing an introduction to finance, the finance as a function of the company, and at the same time also discuss preliminary information about financial markets, and why is it important in the study of finance. Okay. So first, we discuss the role of finance in an organization. So what is finance? When we talk about finance, finance can be defined as the science and art of managing money. So the key term here is that it is important in managing money. So when we talk about managing money, specifically, we want to manage the flow of money. And by flow, we need to manage the inflows and outflows of cash. So when we talk about financial management, the main question in our mind should be how do we ensure that inflows of the company or cash inflows of the company are well managed, and how do we also ensure that cash outflows of the company is well managed. So essentially, that is the bedrock of what finance is all about, or financial management. It is the science and art of managing money, which is essentially managing the inflows of the company and managing the outflows of the company. Okay. At the personal level, when you talk about yourself, meron ka ring personal financial management. At the personal level, finance is concerned about these decisions. Number one, how much of their earnings, how much of their earnings do they spend? People have earnings. So, for example, me, I have earnings coming from my work as a professor, and how I manage my earnings and how I allocate them for spending is part of my personal financial management. Okay. As a result of my balancing act between what I earn and what I spend, a second question is how much do I save? Right? Because savings is important, because savings gives me the ability to consume more than my income in the future. That is essentially the the role of savings, in your personal financial management. Okay? If your earnings is equal to your spending, it means you have no savings, right? And if you are not savings in the future, if you need to spend more than if you need to spend more than you earn, then therefore wala kang paggagalingan, or wala kang balon na pwedeng pagkunan ng additional cash to spend for that thing that you need to spend for in excess of your earnings. Okay? So actually, savings, the function of savings, okay, the function of savings is to ensure that you have future consumption. Essentially, that's what savings is all about. And so therefore, part of financial management, personal financial management, is trying to determine how much savings should you keep, so that in the future you can anticipate future excess spending. Okay. And since you are trying to save something for the future, another important aspect of personal financial management is, where do you put your savings? Is it on hand in your pocket? Okay. Or is it something that is invested, right? And earning money also, or earning interest. So between earnings, so between earnings and spending, okay, savings will arise. And with savings, you need to also understand where savings will be invested. No? And that's what managing money means at a personal level. If we go into a firm level, or in the business context, what does it mean when you want to manage the cash or the money of businesses? Okay. Here are the questions that you need to answer. First, how firms raise money from investors. Okay. So if this is the company, okay, the company cannot do anything without capital, right? So they need to raise money. Okay? They need to raise money. That's the first thing that they need to do. How they do it is part of financial management. Okay? Will funding come from banks in the form of loans? Okay? Will funding come from investors in the form of capital infusions? Will funding come from the public in the form of an initial public offering? Okay? That strategy of how to raise funding is part of financial management. Now, once you have raised the money, so you have lots of money na in the company, right? The second thing that you need to decide as a financial manager is where to invest the money, how to use it, or how to invest it. Okay? That's the second question that you need to answer. Why is it important? No, because you can use it in what? You can use it in projects which earn a return. You can invest it in companies that earn a return. Okay? So once you have the cash, you have to also wisely choose the investments. Okay? Do you invest it in a company, or do you invest it in a business, or do you just waste it in terms of expenses? That's part of the science and art of managing money as far as firms are concerned or companies are concerned. Okay? So this function of the firm, function of finance, which deals with raising money, this is called the financing decision. Okay, that's the financing decision of the company of finance. Okay, here on this side, no, the decision of where to use the money, that is called the investment decision. In finance. Okay, so when we talk about finance, it is really a a decision, or it is really managing where the money will come from. Once you have the money, how to use it properly. Okay, when do you think we should invest? Where do you think we should use the money? No, the money that we invest, what do we get out of it? We get a return out of it. Return, kita, profit. Okay, that's what we get when we invest. Okay, when we raise cash, okay, when we raise cash, or when we raise money from different people, from banks, etc., no, these financing sources have a cost. Okay, so therefore the return that you get out of those investments should be high enough to recover the cost of raising those money. And that's another fundamental concept, no, the cost benefit analysis, right? Because if the return that you will get out of these projects or out of these businesses is less than the cost of raising the finance, of raising the money, no, then it's not worth it. No? So therefore, another guiding principle in finance is cost benefit analysis. No? And that is a critical component of financial management. Okay, right? Aside from these decisions, okay, let me erase some portions. Aside from these decisions, the third decision that finance people will need to support management on is how firms decide whether to reinvest profits or distribute them back to investors. Okay? Of course, when the firm has returns or has profit, okay, and they have paid the cost of financing, there are excess cash. Okay? Finance also needs to make a recommendation on whether to retain this cash or pay it out as dividends. Okay? And that is part of the decision that finance needs to provide guidance in. And that decision is called the payout decision. Okay? Or sometimes it's called the dividend decision. Okay, so those are the three things that we need to think about when we are a finance manager. Okay, where the money will come from, where will we invest it, and if we have excess cash, do we retain it or pay it out to our shareholders? No, so essentially, BA 141 and 142, your two finance courses, will center around these three concepts. Okay. So managerial finance, which we will discuss in BA 141 and 142, concerns the duties of the financial manager in a business. Okay. So, and our concerns is to make sure that we do our job in terms of these three contexts of finance in organizations. Okay. So when we talk about firms or businesses, we're talking about a business organization that sells goods or services. Okay. Firms exist because investors want access to risky investment opportunities. Okay. If you can do things on your own, then you don't need to invest in businesses, right? But we invest in businesses because those businesses are exposed to industries that you might not be able to tap by your own. And that's why we need to invest in firms or companies so that we can invest or be exposed to those riskier investment opportunities. Okay. All right. So what is the goal of the firm? No. So first, for us to manage the finances of the company better, we need to understand what is the goal of the firm. Okay. The goal of the firm for, is to maximize shareholder wealth or maximize shareholder value. Who are the shareholders? Shareholders are the owners of a corporation, right? The owners. So essentially, the objectives in finance, okay, is to maximize the wealth of investors in a company, okay, and that those are the owners in the company. Okay. How is it manifested? For a listed company, it is usually manifested as maximizing the stock price of that company. No? So if you are, for example, looking at Meralco, what is the objective of the finance managers of Meralco? Their objective is to maximize shareholder value. Okay? And it is manifested into the maximization of their price in the stock market. Okay? So essentially, that's what the goal of the firm is. But it's something that's more theoretical, no, rather than actual, right? How do you precisely increase the stock price? Okay, you increase the stock price by increasing the cash flows of a company. Okay, because increasing the stock price means increasing what's called the valuation of the company. And if we talk about valuation, we are referring to the present value of all cash flows of the company. And that defines what value is in finance. Okay? So stock price movements are heavily influenced or primarily influenced by an increase in cash flows of the entity. So therefore, your objective is to increase the cash generation ability of the business, and that will maximize stock prices. Okay? Now, is it not the objective of the firm to maximize profit? Does profit maximization lead to the highest possible share price? Usually, yes. Okay. However, there are at least reasons where the answer is no. So let's look at this example because it gives a good indication of why increasing or maximizing profit is not necessarily leading to an increase in value or stock price. So Nick, no, is a financial manager of a company which produces marine engine components. Okay, and is choosing between two investments, rotor and valve. So those are two investments. The following table shows the earnings per share of the company. Okay, so the company's earnings per share is based on this one. So if you look at the earnings per share for the rotor investment, it is front heavy, meaning the investments, the EPS of the earlier years is higher than the later years. In total, the total EPS of the project is $2.80 per share. Okay. For Valve, on the other hand, in total it is higher. Okay. But in terms of the distribution, it is back-ended. So there's higher earnings per share at the later years than the earlier years. Okay. If the objective of the firm is to maximize profit, then what would be the appropriate decision? The appropriate decision is to choose Valve as the investment, right? All in all, its earnings per share is higher in total versus Rotor. Okay. However, we have to take note of the following issues. Okay. Number one, timing. Okay. Even though in total, Valve will have a higher earnings per share, the distribution is back-ended. So if I get the present value of those earnings, probably Rotor will have a higher present value, right? Simply because it's front-ended. Year one has a higher weight in terms of getting the present value, right? And so therefore, all in all, if you consider the timing of an investment, it might be the case that Rotor might be a better investment. Second is cash flows. Remember, this is earnings per share. Earnings is not equal to cash flows, right? And we mentioned that when we talk about stock price, we are talking about value, and value is driven by cash flows. And so therefore, we need to consider, is the earnings per share more or less approximating the cash flows that we will receive per share? If yes, then probably it will lead to a good decision. If not, then you need to consider cash flows rather than earnings. And lastly, risk. Okay. Even though the expected value of Valve is $3 per share, Valve can be more risky than Rotor. And because it is more risky, even though nominally it's higher, right? But because of the level of risk, okay, it might be the case that what we will expect will be lower, or what we will actually experience is lower than 3 per share. If, for example, this is risky cash flows and this is risk-free, then that's a different analysis, right? $2.80 sure, or $3 that's risky. So that may affect the the profit maximization decision, right? And so therefore, maximizing profit will not necessarily lead to an increase in shareholder wealth. However, it may contribute to it, no? Since usually earnings track cash flows, meaning in the long term, total earnings will be equal to cash flows. No, if you think about it in a very long time or long run performance of a company. Okay. Next. Now, another emerging concept, no, is that the goal of the firm is, rather than maximizing shareholder value, no, finance should be maximizing the stakeholders' welfare. Okay. Who are stakeholders? Stakeholders are the different parties who have an interest in a company. Who are those stakeholders? For example, employees, suppliers, customers, and even members of the local community where a firm is located. Why is maximizing stakeholders' welfare a good principle for a finance manager to do? No, why? Increasing the welfare of your employees, of your suppliers, of your customers ensures that business will keep on going. If your employees are happy, you won't have a problem in terms of attrition. If your suppliers are happy, then you won't have any problem in terms of supply, right? You have reliable, loyal suppliers. No? If your customers are happy in terms of the value of the products that they are receiving, then they'll be loyal. There'll be brand loyalty. And because of that, it will strengthen the business fundamentals of the company, and therefore it will also strengthen the cash flows of the company. So that's the reason behind that emerging thinking. And this is critical in what's called, ito very buzzword ngayon, no? ESG investing principles. What's in ESG? Environmental, social, and governance standards. Okay? Right? Because we need to care for our environment, our community, and our minority shareholders, which are also stakeholders of the company. Okay? So the advancement of stakeholders' welfare will ultimately lead to shareholder welfare, no? Or will ensure the continuity of shareholder shareholder value maximization. Okay. Now, when you neglect shareholder wealth maximization, what are some flaws in it? Okay. Maximizing shareholder wealth does not in any way imply that managers should ignore the interest of everyone connected to a firm who is not a shareholder. Okay. So, remember, maximizing shareholder wealth means maximizing cash flows. No, maximizing cash flows means revenues and expenses are well managed. Okay? Revenues and expenses are connected to your stakeholders, customers, the community, suppliers. They're all part of your ecosystem. No, so making sure that they are protected protects also your revenues and expenses, which protects your cash flows. Okay? To maximize shareholder value, managers must necessarily assess long-term consequences of their actions, which is correct, right? And some of those long-term consequences is pwede kasing cheap yung materials na gamitin mo, right? Pero your customers won't be happy in the long run. So overall, in the long run, the cash flows that you will receive will decrease, no, because you are not developing brand loyalty. Okay? So stakeholder perspective is intrinsically difficult to implement though, no, because it's difficult to balance a lot of interests. Okay. And many people misinterpret the statement that managers should maximize shareholder wealth as implying that managers should take any action that increases stock price. So this is also wrong. Okay. Because if you do any action that increases stock price but jeopardizing some stakeholders, then it might increase the risk of your cash flows and therefore lead to lower cash flows overall, which will lead to a lower stock price. Okay. Now let's look at the managerial function. Okay. So as I mentioned, what is the objective of the firm? The objective of finance in a firm is to decide on investment and financing decisions. Okay. So when we talk about investment decisions, the key question is which assets to invest in. So it's essentially a management of assets. That is the investing decision. Okay. Now, when we talk about the financing decision, it talks about the right-hand side of the balance sheet. Okay. It's management of liabilities and equity. That's what financing decisions are. Okay. And when we talk about investment and financing decisions, okay, for investment decision, one key decision is, should I invest more in current assets than fixed assets or non-current assets? For liability management naman, should I borrow more short-term loans than long-term loans? Okay. Those are the key decisions that you have to decide on, right? The decision, no, on how to raise financing is called the capital structure decision. Okay? Capital structure meaning deciding whether you should finance your asset expansion using debt or equity. All right? So deciding between debt or equity, that is a capital structure decision. Okay? Working capital decisions, on the other hand, no, refer to the management of short-term resources. Okay? Short-term liability management. So the question is, should I finance something using short-term loans or long-term sources? That's the key question that we want to answer. Okay. Now, when we talk about the managerial function, we need to discuss the key principles that are involved in the decisions of management. The first principle is something that you've learned early on, no? The time value of money. Okay. We know that timing of cash flows matter. Okay. Because as our example kanina on Neptune company. Okay. So the timing is important. Delayed cash flows diminishes the time value of money, right? And so the earlier the cash flows are, then that's the better. So that's one key principle for finance manager. Second, I'll skip one because it's related. Cash is king. Okay. Earnings is not equal to cash flows. And what we want is cash flows. Okay. Because cash flows is ultimately directly related to value. Okay. Next, trade-off between returns and risk. Okay. In finance, there is a principle: high risks, high returns. Okay. This is something that we will not study in 141, but eventually you will study in 142. Okay. So there's always a trade-off between returns and risk. Meaning, if you want a safe investment, those safe investments will not necessarily yield the highest returns. If you want high returns, it cannot be in a safe investment. You need to risk something, no? Or you have to have more tolerance on risk, no? Because when you have more returns, when you want more returns, then you should be willing to invest in riskier investments. So there's no such thing as higher return, lower risk. Okay, so that's a scheme, or that's a Ponzi scheme or whatever. No? So there is always a trade-off between returns and risk, and that's something that we want to temper, or at least have an informed decision as far as we are concerned. Okay. Next, competitive financial markets. We'll talk about this more later, but financial markets is a source of financing. Okay. And one key principle is that there is a source of financing because we know that financial markets are going to will be able to accommodate us because it is competitive, right? And last is incentives are important. Incentives are related to the principal agent problem, which we will discuss in a while. Okay, that management should be incentivized properly so that they are able to perform their role to maximize shareholder value. Okay, what is the relationship of finance and economics? The main relationship is this: that it is uh, also applying the principles of marginal cost and benefits. Okay, and that's something that we already discussed a while ago. No? Now, before we discuss the principal agent problem and the fiduciary duty to shareholders, let's discuss where is finance in an organization. So this is an organizational chart. So here are the stockholders. Here is your board. So the stockholders elect the board of directors, and the board of directors hires management. Okay. So the stockholders, through the board, hires management precisely because management the management are called agents of the shareholders. Okay. So management are agents of shareholders. Ano ibig sabihin ng agent? Agent simply means that they are supposed to do what the principal asks them to do. Okay? So the principal, siya yung nag-utos. Ang mag-i-implement yung management. That's the principal and the agent. Okay? In this case, who is the principal? The principal is the shareholders through the board. Okay? Who is the agent? The agent is management. Okay, right? Where is finance in this whole uh, management team? So usually there is a CFO, and the CFO or the Chief Finance Officer is the main finance person in the management team. What is the usual composition of the finance team? Usually there is a treasurer. So the treasurer is the one that manages cash on a day-to-day basis. Okay? So siya ang may alam ano ang pera, nasaan ang pera. Okay? Saan galing ang pera natin, saan natin ini-spend. Okay? Also, you have a controller who is the one in charge of accounting and operations. Okay? By operations, meaning accounts payable, among others. Okay? Usually, you have an investor relations group which coordinates with shareholders. And you have an internal audit team which serves as the check and balance of the company. Okay? So that's what finance does in an organization. Now, what is the principal agent problem? The principal agent problem simply means baka hindi gawin ng agent yung gusto niyang gawin ng yung gustong gawin ng principal, right? There might be a problem that may arise because the owners of a firm and its managers are not the same people, and therefore they are motivated by different things. And therefore the agent might not act in the interest of the principal. No? What is the interest of the principal shareholders in this case? Their interest is maximize shareholder wealth. That is the objective of the shareholders. What's the objective of management? Of course, their objective is to maximize shareholder wealth. But they might be disincentivized to do this. Why can they be disincentivized to do this? Because maximizing shareholder wealth might not maximize their own personal wealth. Right? Ba't ako mag-increase ng shareholder wealth pag hindi naman nag-increase yung sweldo ko pag tumataas ang stock price? Right? So bakit magiging concern ko rin as the agent? I know that I was hired for this, pero still, sila lang naman ang kumikita, hindi naman ako. Right? So I might be disincentivized to always perform, to always promote maximization of shareholder wealth. Okay, and that's why incentives are important. Okay, the incentive structure of management is part of the finance decision because having the proper incentives makes sure that goals are aligned. There's goal congruency between the management and the shareholders. So for example, what is such incentive? For example, bigyan mo ng stock ownership plan. So for example, as part of the compensation of these managers, bibigyan natin sila ng shares of the company. Right? If they are also owners of the company, therefore, they will also benefit from stockholder wealth maximization, right? Because they own shares. So if the stock price increases, they will also benefit. Okay? And therefore, this makes the principal agent problem less pronounced. Okay? Because they have an incentive already to maximize shareholder price, or shareholder wealth, because they are also owners of the company. So because of that incentive, it was able to close the gap between the principal and the agent. So that's why incentives are also important in finance, because it bridges the gap of maximization of shareholder wealth. Okay. And lastly, finance has the fiduciary duty to shareholders. Finance is the guardian of the shareholders. Okay. Primary governance steward of the company. So the shareholders rely on the finance function to ensure that they are maximizing stockholders' wealth. Okay. And that's a very important function of finance, to have the fiduciary duty, to represent the shareholders and make sure that shareholder interests are protected. Okay. Of course, the board is there. but the board only looks at strategic decisions, not day-to-day decisions. So finance has that fiduciary duty to make sure that they are doing what they can to protect the shareholders. What are the other relationship of managerial finance? As far as its relationship to accounting, we know that cash is king in finance. So net income is not the main source of decision making for finance. We are looking at cash flows, right? So there is an emphasis on cash flows as far as financial statements are concerned, or at least financial decisions. Okay, next, decision making. So for accounting, their role is to collect and present data. So most of their attention is devoted to collection and presentation of data. For financial managers, okay, the main objective is to support decision making. So there's more analysis involved in finance. Okay. Now, corporate governance is related to the fiduciary duty of finance. Okay. So corporate governance are rules, processes, and laws by which companies are operated, controlled, and regulated. Okay. So there are rules on it, or there are specific issues related to it. Okay. That we will discuss in class later on. That's it. We move on to the next portion, which is financial market environment. Okay. When we talk about financial markets, or the financial environment, one very important actor in finance are financial institutions, of course. Okay. What are financial institutions? Essentially, financial institutions are intermediaries. No? Para saan sila nag-i-intermediary? They are the intermediaries between the demanders of funding and users of funding. Okay? Through financial institutions, parang they bridge the two. Okay? So who are the users of funding? Users of funding are the people who need cash, right? If you need cash to buy a house, then you are a demander of cash. Okay? So if you demand cash, you are the one who needs cash. Okay? If you're a supplier of funds, it means you have excess cash that you want to lend to others. Okay? And usually, of course, it's difficult to find them. No, financial institutions are there in the middle to coordinate each one. So they will get the cash from suppliers, and the cash that they get from suppliers, they're able to lend out to demanders of funding. Okay? Essentially, that's what financial institutions do. Kaya sila financial intermediary, because they are the ones trying to serve as the market for demanders and suppliers of funding. Okay? So ikaw, meron kang pera na excess, nilagay mo sa bangko, right? Yung paglagay mo ng pera sa bangko, you've actually supplied funding for someone. Okay? Now, the pera that the banks get from deposits and other fundraising activities, they lend it out because those people demand funding, needs funding. And so therefore, the bank is the most efficient way to do it if you want to loan from someone, right? Now there are usually three types of banking systems. One is the commercial bank. Commercial banks are institutions that provide savers with a secure place to invest their funds and offer loans to individuals and business borrowers. Okay, so for a commercial bank, they get deposits and then they lend out those deposits. Okay. Now, next is investment banks. What are investment banks? Investment banks are essentially companies which assist in fundraising activities. Okay. Remember, kanina sabi ko, one of the capital structure decisions is to decide whether um, uh, debt or equity ba ang capital structure ng isang kumpanya, right? Who assists them in actually raising debt and raising equity? Investment banks do that. Okay? So investment banks, what they do is they assist in fundraising. Okay? So parang consultant, so that is their role. Okay? Next is the shadow banking system. These are institutions which engage in lending activities but do not take in deposits. Okay? So they engage in lending but do not accept deposits. All right? What are examples of this? Nakalagay na dyan. Such as funds, like pension funds, like SSS, GSIS, nagpapautang yan sa certain institutions. Okay? Second, insurance companies. Okay? Also can lend out. Okay? But they don't accept deposits because they have other sources of funding. Okay? Now, let's discuss what financial markets are. When we talk about financial markets, anong ibig sabihin yan? These are forums in which suppliers of funds and demanders of funds can transact business directly. So since it's a market, it's an exchange. In economics, what is a market? A market is where you can buy and sell goods and services, right? A financial market is a market for funding. No? So in that financial market, suppliers of funds can sell funds to demanders of funds. And what is that cost? No? That cost is called the interest. Yung interest on a loan, then that is the cost of that funding. Okay? Now, financial markets, the funding that you need might be long-term in nature or short-term in nature. Okay? If the funding that you need is short-term in nature, then that financial market is called a money market. Okay? Kung ang funding mo naman na kailangan mo is for long-term funding, that is called a capital market. Okay? So pag sinabing money market, ibig sabihin pautang yan ng mga short-term. Okay? The supplier of funds only want to supply funds in the short term. The demanders of funds only want to borrow in the short term. So that's what a money market is. A capital market, on the other hand, the suppliers and demanders of funding want long-term sources. So that's why the stock exchange is a money market fund, is a capital market fund. And the market for treasury bills is a money market fund. Okay, because it is only short term. Okay. A private placement involves the sale of a new security directly to an investor or group of investors, meaning you don't go through a financial intermediary, but you go directly to investors without an intermediary. That is called the private placement. Okay. Most firms, however, raise money through public offerings, and the market can be a primary market or secondary market. Okay. If it's the first time that they are raising funds, meaning initial public offering, that's called a primary market. Okay. If they are buying and selling stocks for pre-owned securities, that's called the secondary market. Okay. Now, this is the flow of funds throughout the financial system. So in the left-hand side, you have the supplier of funds, right-hand side, demanders of funds. Okay, let's go first sa supplier of funds. The supplier of funds can deposit their funds to financial institutions. Okay, or they can buy stocks in financial markets. So imaginein mo, kung may pera ka, pwede mong ilagay sa bangko, right? Savings. Right? If you don't invest it, you don't save it, you can actually buy stock. Bili ka ng shares. Therefore, you are lending your money to the financial markets. Okay? And also, you can go directly and invest in one company that through a private placement. Okay? Stocks through the Philippine Stock Exchange. Okay? Right? Now, demanders, on the other hand, okay, they can borrow from banks or they can tap the stock market, right, and issue their shares. So borrow, okay, or do an IPO through the PSE. Okay. Once they do an IPO, they will receive the funds, right? Once they borrow, they will receive those funds. Okay. And once a direct supplier of funds invest to the demanders, then they will receive funds. Okay. Now, what does the supplier get in return? Okay. Sa financial institution, when bigay siya ng savings, may deposit, may interest yan. Right? Now, if the supplier of funds invest in a stock, in the stock market, what does he get in return? He gets dividends. No? Which is considered his return. Of course, part ng babayaran ng demanders of funds is interest, okay, and dividends. Sorry, interest here and dividends here. So these are the cost of funding from the point of view of the demanders of funds. Right? So that's how the flow of funds happen in the financial system. Now, when we talk about the money market, as I mentioned, these are the financial market for highly liquid securities or short-term sources of funding. Most money market transactions are made in marketable securities, which are short-term debt instruments. So examples are treasury bills by the national government, commercial papers issued by businesses. Commercial paper is a short-term note, okay, or negotiable certificates of deposit. So this is time deposits. So those are all part of the money market. Okay, so you usually use the money market if you have an excess cash and you want to invest it, o di pa utang mo sa money market, right? Now, people who need cash on a short-term basis may tap the money market, okay, so that they can get the appropriate funding that they need. Capital markets, on the other hand, as I mentioned, are long-term funds, or the financial market for long-term funds. So when we talk about long-term funds, usually it's in the form of bonds and stocks. So if you want to get a 5-year bond, for example, or issue a 5-year bond, you'd go to the capital markets, not the money markets. Kasi yung money markets, pang short-term lang. Okay? So these are some examples of securities. No? Debt and equity. For debt, usually it's in the form of bonds. So bonds are long-term debt instruments, no, used by businesses and government to raise large sums of money, generally from a diverse group of lenders. For equity, there are usually two types that's in the capital market: common stock and preferred stock. So you know this already from your prerequisite courses. Okay. Now, what is the role of the capital market? The role of the capital market is to bridge funders and suppliers of funds. Demanders and suppliers of funds. Essentially, that's their role. Okay. So with that role in mind, one key concept that's important in the role of capital markets is the efficient market hypothesis. This simply means that if the market is efficient, then the price in the stock exchange is fair. It's fairly priced. And therefore, And therefore, when you issue stock using or you raise funds through the capital markets, you will be assured, no, na hindi ka madadaya sa valuation because it is fair, or it is in equilibrium. But of course, in reality, this is not always true. There are market imperfections. So those market imperfections also shape what kind of capital or what kind of market do you tap. And another emerging topic in financial markets is the role of behavioral finance. Okay, in traditional finance, the assumption is that an investor is an economic agent, and because he is an economic agent, no, there is a presumption of rationality. Okay, when is a person rational? No, because ang objective niya is to maximize utility, right? So he will make the decision based on the utility that best maximizes based on the decision which best maximizes utility, right? But under behavioral finance, the presumption of rationality is relaxed. Okay? No, and therefore it may affect how security valuation is conducted. No, prices of securities can deviate from their true values because of emotions. No? And it may lead to unpredictable patterns in stock prices. So those are competing principles. In other words, the capital markets is there for funding, but how they behave is still under investigation. Okay. Hey, that's it. That's the end of the presentation. Thank you.